For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Now, welcome back to the podcast. That's right, Managing Your Financial Future. We're going to be talking about some real future stuff today. For some people, that future may be, around the corner. I hope not. For others, it may be quite a long time. But it's one of those things that is probably going to happen to just about any married couple. I'm Johnny Dean, your podcast host, here with Professor Rick Plum, certified financial planner professional, and accredited wealth management advisor. Yeah, does this year, Rick, is this year going to be a year where you add another designation?
Probably not.
No? Are you done with designations or,
It depends on what other people around me do and whether or not it seems easy.
Yeah,
I'm getting lazy is what it is.
Yes. If somebody else gets a designation that you'd like and you don't have, you're going to
well, and what happens are people that are getting designations in the office look to me to help them study. And so in my helping them study, I realize I can take these tests cold without taking any study and get the designation. But until somebody comes up with the study materials and I'm helping them study so that I can see that I can do it without too much effort. Let's be real.
Well, you are the professor, and they come to you for office hours. Is how that works. So, well, good for you. Anyway, So today we're going to be talking about something that I guess nobody really enjoys thinking about, but it's something that, as I said before, virtually every married couple needs to understand, and that's what happens financially when one spouse passes away, because in almost every case of a marriage, one of the spouses will outlive the other. They almost never go at the same time. That's exceedingly rare. So this means there will be issues with a survivor. Now, this is not going to be a doom and gloom episode. It's I think it's more
just facts, just the facts.
Right? Yeah. It's clarity, I guess. Because, Rick, over the years, we've seen that. I know you have. People assume certain things will happen, and then they don't, or they think something extra kicks in, and it doesn't. And I think what makes this topic important for our listeners here is that many of the changes that happen after the loss of a spouse can happen automatically. Social Security changes. We'll get into that. Tax filing status. Income can certainly change. And if you don't know that stuff ahead of time, you're not prepared for it, it can feel like you're getting hit from 3 or 4 different directions at once. And that's not good, especially if you're kind of still in a grieving process. So anyway, today we're going to examine 4 things that every surviving spouse should know. I'm sure there are more, but we came up with 4. So if and when that day comes, you got fewer surprises and I hope more control. All right, Rick, let's start with the one that I think shocks the people the most. And that is that one Social Security check goes away when a spouse dies. Now, it makes intuitive sense that one will go away, but there's some confusion here. So I think you know where to start with this one. Talk about what happens with Social Security when a spouse passes away.
Well, it seems to be a fairly common misconception that when a married couple is looking at their benefits, they see that they have their own benefit, and then they also do their own research, and they find out that there is a survivor benefit. If you are married and your spouse who has a Social Security benefit dies, there is a potential survivor benefit. What unfortunately a lot of people have the misconception about is that they will continue to get their own benefit and the survivor benefit, all of the survivor benefit. And that, as I've alluded to, is not necessarily true, because what happens are you get the higher of the 2 numbers. The reality is you could end up getting 2 benefits, but one of them is a partial benefit. Let's say your benefit was $2,000 a month and your spouse passes away and you become eligible for $2,500 a month of spousal benefit. Well, they're not going to give you your $2,000 and another $2,500. What happens are they look at, okay, what's the higher of the 2 of them? We're going to give you $2,500. So you're going to continue getting your own $2,000 and a spousal benefit of $500. So you're getting a spousal benefit, but you're not getting it all on top of your own. You're only getting the difference between the two. Basically, the way you can look at it is you'll get the higher of the two. Now, the survivor benefit isn't exactly the same as the full retirement age benefit or your own benefit. So there might be a couple bucks difference anyway, but you're not going to get them stacked on top of each other 100%. If your benefit is the higher benefit and the lower benefit spouse passes away first, you're going to just continue to get your own benefit and you'll get nothing from that survivor. The only time you will get an increase from your own is if it's the lesser of the two and the higher benefit spouse passes away first. But again, you're only getting the difference between the two, not both of them stacked on top of each other 100%.
This is where people get confused because, as you said, they hear about a survivor benefit. Now, here's where people can I think get stuck, and it can depend on what each of the spouse's benefits are. Talk about that for a moment, because if you both have a similar benefit, the spouse passing away can have a bigger
you have
impact.
a much bigger impact on the loss of income when you both have very good benefits. Let's say you were both reasonably high wage earners. You both worked until full retirement age or longer, and you're both receiving, like $4,000 a month or more from Social Security. So you've got a very nice income from Social Security in that respect, of more than $8,000 a month just from Social Security. And that's not unheard of. I mean, right now, the best full retirement age benefit is a little bit over $4,000, but a lot of these people will work until 70, and then at 70, the best benefit's a little over $5,100 a month. So you may be getting $4,000, your spouse be getting $5,000, or vice versa. Compare that to somebody who has, a more traditional benefit where one person may be getting $3,000 and the other person started very early and is only getting $1,000. The first one, we're talking about half of their Social Security income basically goes away. In the other aspect, only 25% of the total Social Security benefit goes away. So where are you on that scale? The more equal the benefit, the bigger the impact is going to be when one or the other of those spouses passes away. The higher the disparity between the two benefits, the less the impact is going to be when one of those spouses passes away.
Yeah.
Now, we're also assuming that you're not going to take a double whammy where, your spouse started at age 62, they were the higher wage earner, and then you took your benefit at 62, and then the spouse passed away before you get to your full retirement age. Maybe they passed away when you're 63. You're going to probably get a double whammy because you're not going to get that you're not even going to get that full benefit that they were receiving. You're going to get a lesser benefit because you're not even 67 years old yet. So you have to know what's available, know when to hold them, know when to fold them, and know what's going on, because you can continue to receive your own benefit until full retirement age and then get the full survivor benefit. But if you apply for the survivor benefit before your full retirement age, it's discounted as well as, just like, it's not exactly the same discount as all the others, but it's discounted too.
Well, you receive less. So what you're saying is, if you had two $4,000 benefits and one spouse passes away,
you lose half.
One of the 4,000s is going to go away. So your Social Security benefit in this case would be cut in half.
Your total benefit for the household is cut in half.
Yeah, $8,000 to $4,000. But if you had a $4,000 benefit and you're
total,
and your spouse, well, let's say you had one and the other spouse didn't work that much, but they have, say, $1,000, and one of those, it doesn't matter which one passes away, you're only going to lose the $1,000 benefit. So your Social Security income in that instance would go from $5,000 down to $4,000, which is not great, but it's better than losing half. So
it doesn't work quite that horrendously, because if I have a $4,000 at full for retirement age, and my spouse wouldn't, assuming they're full retirement age, they're going to be receiving more than $1,000 a month. They're going to be receiving $1,400 or so.
Well, okay. Well, but either way, I think
they're
just
still losing less as a percentage of the overall income to the household than somebody who has equal benefits.
Yeah, just for illustrative purposes, that's what that was. You get it. So just be aware, if you and your spouse have similar or equal, roughly, benefits, that when one passes away, that impact could hit you. So that's one. Now here's another one that a lot of people don't think about, is that your married filing jointly status goes away, assuming you don't get remarried. But let's just say in the year after the year of death, you are now a single individual filing.
Oh yeah, I mean, and that's a big one because, as a married couple in 2026, you can have $145,000 of total adjusted gross income and stay in the 12% income tax bracket. And as a single tax filer, you can only have, let me look at my numbers here. We got $50,000, $60,000 or $75,000, maybe $80,000 of income and stay in the 12% bracket. So that's a big difference in income. You may lose $20,000, $30,000 of Social Security, but if you're at that 145 and you lose 20, you're at 120, and now you've got a big chunk of your income, not just in the 12% bracket, you're in a 22% federal income tax bracket. And so it does have an impact. So not only did you lose income from a lost Social Security benefit, you have less income, but also one of your most hated expenses has just gone up. Taxes being that expense that nobody really likes, you're owing more in taxes. And it goes by what your filing status is as of December 31st of the year, except for the year which somebody passes away. When somebody passes away during the year, the surviving spouse gets to continue filing jointly for that year. But then the next year, they were single for the whole year, and they're single on December 31st, assuming they didn't get remarried. And now you're a single taxpayer. There's no survivor tax bracket. It's a single tax bracket. And it happens starting the year after the year of death. Expenses, they go up.
Well, and it could be that, you've got, maybe some people have a fairly high income. They've got, a pension that survives the spouse that passes away, so that doesn't get affected. Maybe they have a little hit on Social Security, but it's not that much, and they just need a lot of money to survive on from month to month. So their income may not go down a whole lot when the spouse passes away, but all of a sudden those tax brackets have been chopped basically in half in many cases, right?
Yeah, and so, like I said, you lose income and you have more expenses. That's a double squeeze. You're getting hit on both sides.
How do you plan for that? What do you do as a financial planner? I mean, these discussions come up, I'm sure, with clients.
Yeah, and this is one of the areas where I talk about Roth conversions the most. That maybe we're not at the $145,000 level, maybe we're only at the $110,000 level, $100,000 level. And I'm in a true 12% bracket for another $40,000. I'm going to probably be in the 12% bracket the rest of my life unless they change the tax code. So what's the advantage of doing the conversions? The advantage isn't for the joint couple. It's for that surviving spouse. So if I can convert, $30,000, $40,000, $50,000 a year for the next 5, 8, 10 years while they're both here, that way when the inevitable happens and we have a survivor issue, now we can start taking less money from the IRA and more money from the Roth IRA to keep the taxes at bay. Ooh, that kind of worked.
Sometimes these things just pop up.
But yeah, so that's where I look, for the most part with married couples, the Roth conversion isn't for their joint life. It's for that survivor, because we want to try to avoid as much of that double hit, loss of income and additional expense. So if we can, losing income is bad enough. If we can do it without, and start using Roth IRA distributions to help supplement the income, that keeps them out of the tax brackets that may hurt them.
And this could be a challenge, especially for married couples who have a fairly high income, because, trying to find a window, an opportunity to do some of these Roth conversions while they're married, can be a challenge, right?
Well, it can. And there are little landmines all through the tax code. And so while I was talking about being in the 12% bracket, they may say, well, let's use some of the 22 as well. Well, the 22 extends quite a ways, but we hit a little landmine. While still in the 22, we hit the additional Medicare premium. So it adds to the overall cost.
So many things to look out for in this particular situation. But married filing jointly goes away. And again, as I had said with the Social Security check going away, it is something that I think people will say, well, sure, yeah, I guess I'd be single. So, but it couldn't be much of an impact, could it? And the answer is it can be a big impact from a tax standpoint.
Any additional expense to somebody living on a fixed income. Now, that's kind of a strange statement because I technically live on a fixed income because I have a salary and it's fixed.
Yeah, right.
But it's a little bit bigger than Social Security, I hope.
Well, fixed income, meaning that you're not getting...
Yeah, so you don't have any way to increase it. You don't have any way around it. But your income just went down and your expenses, then now we have to focus on where are our expenses that we can control.
Yeah, and we talk about taxes as being those that nobody likes to pay, and there are ways to control that. So those are the first two of the four. A Social Security check goes away, and married filing jointly goes away. Again, assuming you stay single, which is entirely up to you, but that's more often the case. So the third thing, and you broached this subject just a moment ago, but the third thing that surviving spouses need to know is that your Medicare costs can go up and not down. Now, most people assume that losing income, even a little, means that everything gets cheaper, but Medicare really doesn't work that way. You mentioned this so-called IRMA, I-R-M-A-A, the income-related monthly adjustment amount, which can happen, I think, as you said, in the 22% bracket. Talk about what happens with Medicare and this whole IRMA surcharge.
Well, IRMA, income-related monthly adjustment amount, is something that says if you make more than a certain amount of income, modified adjusted gross income, then you get the privilege of paying more for your Medicare premium, Medicare Part B, Medicare Part D, Medicare Advantage. You get to pay more. How much more? How high is your income? There are different threshold amounts. And so if it currently, and what they do is they look a couple years back, we'll just assume that we know what the numbers are. Right now, for a married couple, you can have up to $218,000 in a modified adjusted gross income and not be subject to IRMA. That first step in IRMA adds another $81 a month to each of your Medicare premiums. But single individual, this is where going from a married couple to a single, basically taxpayer, can hurt again. Like I said, you've got $218,000 of room for the first level of a married couple, but only $109,000, half of the married side, before you get into IRMA for a single taxpayer. You take that person that's at the top of the 12% bracket, they're making $146,000, $147,000 of adjusted gross income, and they lose one of their Social Securities. Maybe they lose $30,000 of Social Security, which is a big drop. But that drops them down to $116,000, $117,000 of modified adjusted gross income. Well, that's over the threshold for the single person. Mm-hmm. So now not only did your taxes go up because you're no longer all in the 12% bracket, you're partly in the 22% bracket, but your Medicare premium went up $80 plus a month for that year, and then every year after that. And so depending upon where you are on the income thresholds, that Medicare premium goes up pretty quick. I mean, the first jump is a little over $80, but then the second jump, which is only at 137, 109 is the first threshold, 137 is the next one. It goes up by another 121. So it's basically a $200 increase from the standard premium if you go up from 108 to 138. That's only $30,000 difference. So we have to watch out what's going on. And these are some of those little landmines that I talked about in the tax code. It's not just the tax bracket itself, the marginal tax bracket. It's what else is out there. Mm-hmm. It's the inclusion of Social Security in the taxable column at the lower levels. It's the additional Medicare premium at the higher columns. It's the net investment income tax. There's all kinds of little things that add to, and they chip away at your ability to keep money in your own pocket.
Do you see the situation? You mentioned, maybe a Social Security goes away if it's like $30,000. But do you ever see where people say, "Well, my $30,000 of Social Security goes away, so I'm going to replace some of that income with extra, IRA withdrawals"?
Well, that happens quite often.
Yeah,
most people just can't take a $30,000-$40,000 hit to their income. It's more expensive for two people to live than one people to live. I speak so well. But how much did that one person actually spend that was just purely on themselves? Is it a $40,000, $50,000 difference, or is it a $10,000, $20,000 difference? How much am I going to spend less because there's only one of us instead of two of us? That is a factor that we can look at, but we don't know that number until, unfortunately, after somebody's gone and we realize what expense was purely theirs. Unless we have somebody who is, I have some clients that have specific hobbies for one of the individuals, and they can be very expensive hobbies. And if that person were to pass first, that hobby goes away, and the surviving spouse is going to have a significantly lower overall expense. But that's life. I mean, that's what makes them happy, and that's how they run their life.
Yeah, I know this family, this Plum family, where there's a fairly expensive hobby happening, or two, but we won't get into that. So those are three of them so far. Big stuff that you need to watch out for. Social Security check goes away, married filing jointly goes away, and your Medicare costs can go up in some cases, not down. But you need to know this because you don't want to be surprised by things like this. The last one we're going to talk about here, the fourth thing, is another important one. These are all important, but inherited retirement accounts work differently. Rick, without getting too far into the weeds on this stuff, talk about why a widow, if you want to call them that, can make an irreversible error.
This is more of an issue for younger people, I believe, and it has to do with, unfortunately, younger people don't do a lot of planning because they don't think they have the assets to do any planning with. But what we see with a lot of people who are not yet retired, that they have most of their money in 401k, IRA, tax-deferred environments, and if they've done proper planning, they've got the right kind of insurance and other things, because that is important for younger people, especially younger people with kids. This won't be as big of an issue, but a lot of times we'll see somebody where they unfortunately lose, and in many cases it's a major breadwinner, and that income is gone, but they have the 401k, they have the IRA that they can start tapping into to get them through the area. They didn't have enough insurance. Well, if the surviving spouse, who is under the age of 59 and a half, rolls that 401k or that deceased individual's IRA into their own IRA, which is an option. It's a very popular option. And once you're 59 and a half, in many cases, it's the preferred option. Once you've rolled it into your own IRA, now you can't touch it until you're 59 and a half without a penalty. And so if you don't have enough insurance and you need that money from that IRA, you don't want to roll it into your own name. You want to leave it in the deceased's name as a beneficiary IRA for the spouse, because death is one of those things that gets us away from the 10% premature distribution penalty, as long as we leave it in the decedent's name.
Mm-hmm.
But if, as a spouse, we can roll it over into our own name, and then it's as if it was our own IRA from day one. We do not have access to our own IRA without penalty, with very few exceptions, until we're 59 and a half. So when we're planning and we're unfortunately dealing with the death of an individual, we want to look at the need, the liquidity need. When might we have to touch those IRA assets? And if it's sometime between now and when you're 59 and a half, it's probably best to leave it in the name. Now, you can still move it to the broker firm or the investment firm or whatever that you want it at, because they can open up a beneficiary IRA for you. But you just have to make sure you have it titled correctly, so you don't lock it up and basically hinder your ability to get to that money if you need to.
How many people know this? When I first heard about this,
hopefully every advisor does.
Well, the advisor should, but people who aren't, kind of just either not working with an advisor or they don't pay a lot of attention to it. I mean, this kind of thing can really hurt you.
Now, for older individuals who are worried about required minimum distributions, and that means that they probably aren't spending the money in their IRA anyway, we have to look at the age difference. And it doesn't always happen that the older of the two passes away first. Sometimes, unfortunately, the younger one passes away. And so, again, knowing the rules. If you've got somebody who's got required minimum distributions, maybe they're 75 years old or so, but they don't need them, or maybe they're 80 years old, but their spouse is only 65. I'm making numbers up. I don't have anybody in mind for that one. If the younger spouse passes away, if the older spouse then transfers all that money into their own IRA, which is very common, very possible, it keeps it simple. It's one account. Everything's going easy. Now you have a much larger required minimum distribution. If you had opened up a beneficiary IRA, you could have left the money in the name of the deceased younger spouse who did not have a required minimum distribution and won't have a required minimum distribution from that beneficiary IRA until that younger spouse would have hit required minimum distribution age, which may be 75 for a lot of people, where the older one has RMDs now. That gives them more time for planning. It keeps their RMD a little lower. It lets them do some conversions on top of the RMD. Obviously, you cannot convert the RMD. But if I've got to take 2 RMDs or double the RMD, I don't have the room to do the conversions. So understanding your options, and don't just, well, I can roll it to my own, boom, done. Know what it affects. Know where the flexibility is. Know what the pitfalls are, and the benefits and advantages of doing it one way or another can save you money. And I like saving money.
Especially when it comes to taxes. Now,
especially at the expense of taxes. Yeah, I want to save money.
Oh, you better believe it. And, this is one of those decisions. If you roll it into your own name or whatever you do with that, you can't undo it. I mean, once it's done, you can't just say, you know what, I just realized I did this last year. I made a mistake. I'd like to put it back into the deceased person's name, or whatever mistake you might have made with that.
Nope. Not gonna do it. Not gonna do it.
Well, that's why it's so important to know about this stuff. And as I was saying before, when I first heard about that, I said, man, I mean, that can be a really big mistake. And I don't know how many people even know about this kind of thing. Now, very quickly here, we're kind of just about running out of time, but there is, I think you kind of alluded to it. Widows or widowers, do they even say that word anymore? I don't know. Surviving spouses.
Mostly they call it survivors.
Okay, so surviving spouses.
You get that, masculine, feminine talk out of there. There is no such thing.
Right. So, but the surviving spouses may have a brief window in the year of death, I would say, where you have a chance to maybe take care of a few things where your income might be lower, but your married filing jointly still applies. Do you ever use that window of time, or is that just
Of course. Yeah, I mean, especially for people who pass away early in the year, the surviving spouse, and they lose part of a pension, they lose one of the Social Securities. And we still have, for this year, the year of death, the married filing joint tax return. So we have that ability to potentially make up some room for this one last hurrah, so to speak, in the married filing joint tax return.
Yeah, and it makes sense to talk to an advisor. And
it doesn't help as much if the person dies after Christmas, because there's just all the income's already been there. We've already got all the income. But the earlier in the year, unfortunately, they pass away, the easier it is to manipulate in your favor. That sounds horrible, but that's life.
I know. When we're talking about this stuff, we try to be sensitive to that kind of thing. But at the same time, these are very real issues that people have to deal with. And just knowing what your potential options are, I think, can help you. And these are things that you really probably need to learn about beforehand. So the 4 that we mentioned, just to kind of put a wrapper on that, the things that every surviving spouse should know. 1 Social Security check goes away. Married filing jointly goes away in the year after the year of death. Medicare costs can go up, and then inherited retirement accounts have certain rules that have to be understood. Is this, just last thing for you, Rick, is this something that you have to often bring up to people, or do they ever come to you and say, I don't know what to do here? How does that normally work when a spouse passes away?
There is no normal. I mean, it's all over. Some people don't think they know what's going on, but when we start talking about it, they actually do. Some people think they know what's going on, and they actually have a lot of misconceptions about things. So it's just a matter of sitting down and talking about what they want to accomplish, what they want, and then building the strategy to get as close to what they're trying to accomplish as possible.
It's not a fun time, but it's important anyway that these kinds of financial matters are taken care of. And if you're already working with an advisor, I think you've got a leg up. None of this that we've talked about here is meant to be alarming in any way. We just want it to be educational. But the financial side of losing a spouse, as I said, that's complicated enough with all these kind of surprises layered on top of it. And that's the key here. Most of what we talked about today, Rick and I, isn't something that you fix afterwards. It's something you got to plan for beforehand. You got to know how Social Security works, what happens to your tax filing status, all the Medicare changes, all that kind of stuff. It helps to know ahead of time because you could just run out of time and it's too late. These are the kind of conversations that advisors at Lucia Capital Group have with their clients every single day. Rick, I know you talk about this constantly, don't you?
It's unfortunately because while individuals generally only have to face those types of issues once, maybe twice in their life, loss of a spouse. We deal with it. The longer that I've been in this industry, the more I've had to deal with it. Kind of because many of the people I'm dealing with are getting older, just like me. I guess I'm getting older. Oh, darn. But we've dealt with it a lot more. Just like, one of our little taglines is you retire once, we retire every day, because we are helping people retire multiple times a day in the cases. You go through a survivor issue once, and we go through it we've seen it many more times, and we've fortunately or unfortunately walked through the steps with people, maybe not you, obviously, but with others. And so we've seen what's happening out there.
Yeah, that's how experience counts, and not just planning for retirement, but planning for what retirement looks like over time, including these life changes. If you want to talk through how your own plan might hold up in a survivor situation, you can give the folks at Lucia Capital Group a call. 800-644-1150, 800-644-1150, or go to luciacap.com, LUCIACAP.com. Learn more about the planning process. We've got some guides to download. I know I keep mentioning these, but I'd like you to read them however you can. The rollover guide, I was told, yes, we do have that, so that's good. Social Security guide, that's always helpful to have. Retirement guide, estate planning, that's something we don't talk about a lot on this show, but that kind of goes hand in hand with a lot of this stuff. So type that into the search bar at luciacap.com, download it, and get answers to the questions that I think matter the most to you. Don't forget Apple Podcasts and Spotify. Make sure you subscribe to this podcast and you listen to every single episode. We appreciate that. I like to see those numbers go up every week, which is kind of nice. It boosts the ego. Apple Podcasts and Spotify. We're out of time. My thanks, as always, to Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean, managing your financial future. Thanks so much for listening. Have a wonderful day. We'll talk with you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at sa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. LPL, the financial insurance license number 0518721. LPLIA insurance license number 0B91442.